Good evening and welcome to the first session of our summer term money webinar series by the Institute of International Monetary Research in collaboration with the Vinson Center for the Public Understanding of Economics and Entrepreneurship at the University of Buckingham. Today's webinar is also in collaboration with one of our partners, the Institute of Economic Affairs. We are very thankful for their support and for hosting the events for us. I'm Dr. Juan Castaneda, Director of the IIMR, and today we'll be hosting a roundtable discussion on the state of the economy and on inflation outlook for 2021 and 2022, with three excellent economists, all of them affiliated to the IIMR. Tim Congdon is the founder and chairman of the IIMR, previously the founder of Lombard Odier Research, one of Margaret Thatcher's economic advisors, and a member of the Treasury panel from 1992 to 1997. He has written extensively on money, inflation, and central banking. Geoffrey Wood is a professor of economics at the University of Buckingham, and previously he has taught at the University of Warwick and City London University, as well as visited other universities outside the UK and collaborated with several central banks, including the Bank of England and the Federal Reserve Bank of St. Louis in the US. Geoffrey has written also on a wide range of monetary issues, including financial stability. Brandon Davies is the former treasurer for Barclays Capital and is currently a visiting lecturer at the University of Buckingham. He's a member of the Financial Markets Group at the London School of Economics and has written on new means of payments, bank regulation, and on banker risk analysis. All of them are members of the teaching staff of the University of Buckingham's master's program in money, banking, and central banking. Today, we will discuss the state of the economy and inflation outlook for 2021 and 2022, after which we allow time for questions with viewers at home. Today's presentation will be recorded and made available on the Institute's YouTube channel. Questions must be submitted via the chat option on Zoom. I will moderate the questions and I will address the speaker. I now invite Tim Congdon to start, who will be followed by Geoffrey Wood and then Brandon Davies. Please.
Hello, everyone. Thank you very much for joining us this evening. I've got about 10 minutes to talk about the world economy. I'm going to say a little bit about why I set up the Institute in 2014 and about the MSc course that we teach in at the University of Buckingham. I was very worried, well, I've been worried all my career, really, it goes back 40 years, about the way in which macroeconomists tend to ignore the quantity of money in the way they analyze the economy. And this, in my view, explains why such horrors as the boom of the early 1970s, the late 80s, to some extent the late 2000s, why these things happened, followed of course by busts. And one of the things that we teach on the MSc course is the role of money in the economy, the role of money in banking. As it happens, we're at a very interesting time at the moment as we come to the end of the COVID-19 pandemic. And this is going to illustrate, I think, very well the important work that the Institute does and why you should, if you're interested in this kind of thing, why you should come to our MSc course to learn more. About a year ago, there was a consensus among economists, kind of 90% of the profession, that COVID-19 meant a recession lasting some years. And this is illustrated by a quote that I'm putting here in a picture frame, a bit cruel of me, but still, this is June 2020. This is the forward-looking research simulations from the research staff of the American Federal Reserve, the American Central Bank. They suggested that the committee would have to maintain highly accommodative financial conditions for many years to quicken meaningfully the recovery from the current severe downturn. Notice that phrase, for many years. In other words, this disinflation was going to last forever. And Juan, if we look on to the next slide, please. This is something that I said about the same time. And this is all, by the way, in the monthly videos that the Institute produces. I said that any quantity theory analyst looking at the data and believing in the underlying stability of money holding behavior of people and companies, so leading the mean reversion of velocity of circulation, has to forecast a big rise in American inflation in 2021 and or 2022. And I also said, so one of my gripes, this is the standard macro model usually ignores money altogether, or at best adds it as an afterthought. So you had here a sort of a very nice test case, a sort of laboratory experiment, if you wish, of whether consensus macro, which ignores money more or less, or whether the quantity theory is right. Consensus view, disinflation over many years, quantity theory view, an inflationary boom. Well, it's now June 2021, and the latest figure for the US Consumer Price Index is an increase in the last year of 5%. Business surveys demand most buoyant for years, for decades, problems finding staff, bottlenecks, etc., etc. In my view, upward pressures on inflation intensifying. So we've got an interesting case here. But the funny thing is that the consensus view is in fact that this upturn in inflation won't last very long. So I just very quickly, it's only got a few minutes, and just show you that that's not my view, and I think the Institute's view. Juan's very much on my side in this. Can we come on to the next one, please? This again looks backwards, but this is even April last year. I said that we might see in America, given what was happening there and this money explosion that the Federal Reserve was engineering, we might see 5% or 10% inflation. We've seen 5% already. What about 10%? Could that happen? Is the consensus again completely wrong? Are we okay? Now, the kind of thing we need to look at, and let's move on, next one please, Juan, is, what is it that, it's the most basic question in macroeconomics, what is it that determines nominal national income, nominal GDP? And I would say that when thinking about nominal, the price level multiplied by the quantity of goods and services, we need to have how much money people want to hold relative to their income and transactions. And then, of course, the quantity of money itself, which is set by the banking system. And I say we're lucky to have Brandon Davies with us this evening because he knows all about banks and how banks work. Banking is crucial to the economy. Okay. Let's look at this on the left-hand side here, the actual velocity of circulation until in recent years. And I can tell you it's been pretty stable, actually, in the United States for the last decade or so. A bit over 1. National income has been a little bit less than the quantity of money. So the velocity has been a bit higher than that. Coming down over the years, velocity coming down over the years ever so slowly. Let's suppose, and you can see then in 2020, quantity of money going up. That's right-hand side, an explosion in money. April, May, June last year. The annual rate of growth reaching in June 26%, the highest figure since 1943, since the Second World War. You've got that explosion in money. Then, of course, there was COVID. People were scared. They kept the money in the bank. They didn't spend it. They couldn't spend it. Coming to the end of the pandemic, life is returning to normal. I put it to you that the velocity of circulation will also return to normal. Okay, let's just suppose, I'll try and give as much rope as I can the other side, that by the end of next year, velocity hasn't got back to where it was in 2018 and 2019, but it's 5% less. Okay, but it ought to get back to normal at some point. Life's going back to normal, isn't it? Let's also assume that the rate of growth of quantity of money from now on to the end of next year is 5% a year at 5% annual rate, much lower than it has been in the recent past. Again, I'm trying to get as sympathetic an interpretation as possible to those who believe that inflation is under control. Can we now move on to the next picture, please, Juan? Okay, well, if you do this, what happens? Well, I can tell you the answer is very simple. Because of that fantastic 26% growth of money that we had in the year to June 2020 in the United States, the implied level of US national income at the end of next year is 30% higher than in the first quarter of this year. Okay, so if we're to get to that kind of figure, to get back to monetary equilibrium, as I'd put it, then there needs to be a 30% jump in national income. And that's going to be split, of course, between the increase in output and the increase in prices. Increase in output, at the moment, companies are saying it's difficult to recruit. Other companies complaining about they can't get raw materials. There's already been some inflation. I find it unlikely that American output can rise more than 7-8% between now and the end of next year. On that basis, the price level has to rise 20% or so. Look, I don't know exactly what's going to happen. Nobody does. The Federal Reserve doesn't. They got things hopelessly wrong a year ago. I think it's only very, very likely that in the next 2 years, we're going to get an inflation problem of a kind we haven't had for 30 or 40 years. And this is the result of the explosion in money that occurred last spring. And unusually, this tiny institute that we have here at the University of Buckingham, we got it right. Basically, the rest of the world got it wrong. Thank you.
Thank you, Tim. So now let me stop sharing the screen. It will be for Geoffrey, please, to start the presentation. Please, Geoffrey.
Well, thank you very much, Juan. I enjoyed Tim's remarks. I would like to start by adding to them. He mentioned the work done at the Institute of International Monetary Research. He focused on a very important part of that work, on monetary theory and monetary policy with regard to inflation. It's also the case that no economist, nobody, can understand money and its role in the economy until they have studied the history of central banking, the history of banks, and the development, the evolution through time, because these are also very illuminating on what is happening now and what is going to happen in the immediate future. And in these remarks, I'm going to illustrate that by showing how the history of central banking and its development reveal just how big the problems that we're going to have almost certainly are. Central banks developed, they weren't invented. And they developed, the Bank of England first, and then the Sweden's Riksbank, developed by acquiring two crucial roles which we call nowadays monetary stability and financial stability. Monetary stability is concerned with maintaining stable prices or more or less stable prices through time. Financial stability was classically, by which I mean the 19th and most of the 20th century, as maintaining the stability of the banking sector. Notice I emphasize the banking sector because in this definition, as was emphasized from the very beginning, firms could fail, firms could leave, and firms could enter. But care was taken to ensure that individual firms could fail without these failures spilling over to the banking system as a whole. And this was done by what is called a lender of last resort operation. If there was a sudden demand for cash from the banking sector, because people, let us say, rushed for cash since they were afraid of the stability of the bank, and this cash was supplied by the central bank to the banking sector on security, so that these banks in turn could provide cash to their customers, and the panic would thus come to an end. So it provided stability for the system as a whole. It was not concerned with the stock market. It was not concerned with individual banks. It was not concerned with the exchange, with the foreign exchanges. It was concerned with the banking system and the banking system only. And I emphasize that worked very well. In Britain, it prevented the Great Depression, which occurred in the United States, from occurring here. That was of great importance. In the 19th century, it made the British economy much less volatile than the US economy. The US economy then did not have a Federal Reserve, and in the early 20th century, it acquired a Federal Reserve which appeared to be as incompetent in financial stability as Tim has described it in monetary stability today, because it led to the Great Depression. The Bank of England did a very good job of maintaining financial stability in Britain for getting on for 150 years. What has gone wrong today? What has gone wrong today, I think, are basically two things. The role of the definition of financial stability has been broadly has been broadened. It has been broadened to include all sorts of other functions. This is seen if we look at two central banks, the ECB and the Bank of England. The Bank of England was instructed, rather its Financial Stability Committee was instructed, in a letter from the Chancellor, to encourage the development of the economy in the green direction, like buying green bonds, by encouraging green development. In other words, the Bank of England was encouraged to join in the direction of investment. Exactly the same intention has been declared by the European Central Bank. This, of course, raises the question, what is a green bond? Is the central bank qualified to judge it? The answer, of course, is no. It has no idea what they are. There's no way of judging it. But much more damagingly, it engages the central bank in the direction of investment. That has been tried before by central banks, and it has failed. The classic example in modern times comes from New Zealand. New Zealand pioneered central bank independence. Why did it do that? It did that because monetary policy had been heavily politicized in the run-up to this grounding of independence, and was eventually run by the politicians in great detail. Indeed, it got to the level where the then Prime Minister of New Zealand, Robert Muldoon, was actually directing individual bank loans in directions he thought was appropriate. This meant the Treasury, the New Zealand Treasury, actually referred to central bank independence as a way of stopping monetary policy being Muldoon, being distorted by the Prime Minister. And what did this distortion do? It meant that New Zealand slipped from about 5th highest income per head in the world in 1950 to about the 25th in the 1980s. It was a disastrous policy, and it led us the direction which Britain and the ECB seem to be going in now, if the Bank of England carries out this mandate and starts to focus on green bonds. And of course, I cannot see much chance of their resisting this mandate. At least they haven't written back to the Chancellor in terms which might say, to be polite, are you sure, Mr. Chancellor, you know what you're doing? So that is a great danger. They're going to slow down economic growth long term. A second danger is caused by the actions of the Monetary Policy Committee, because they, of course, have engaged in tremendous quantitative easing. And this Brandon Davies will be discussing technicalities of this later, and that engage in it with the intention of lowering interest rates. Now, lowering interest rates sounds to anyone who doesn't think about the banking sector a very good thing, but it's actually a very dangerous thing, because lowering interest rates make it much harder for banks to earn profits in the normal business of banking, borrowing and lending. And of course, if banks are not profitable, then they're much more exposed to shocks. If one thinks, in other words, that it's bad that banks, you're worried about banks having profits that are too high, let me assure you that banks having profits that are too low are much more dangerous for the economy as a whole, because they can lead to an economic collapse. And there is another danger from these policies of the Bank of England. This policy is, first, that it reduces investment. How does it reduce investment? It sounds as if low interest rates encourage investment. Well, the problem is, of course, in countries such as Britain, there are a large number of pension funds, and pension funds are major investors in industry. But to invest in industry, you need to have funds to invest, and firms which sponsor these pension funds, underwrite the funds, need to have funds to invest. If these pension funds are in difficulties because the value of their assets are falling, as bonds which they hold are falling when interest rates are likely to fall, then, of course, companies have to pay into the pension fund, and paying into the pension fund is the first claim on the free flow of cash, and this makes it harder for them to invest. So it deters investment by companies. Also, these low interest rates have another and perhaps even more damaging and long-term effect. And this long-term effect is that they keep alive what we call zombie firms. These have been a problem in Japan for many years. Zombie firms are firms which are propped up by cheap credit, which ought to be dead, but are not. If there are zombie firms in an industry struggling on, this makes it harder for new entrants. And new entry is absolutely essential to economic growth. To quote that great but erratic economist, Joseph Schumpeter, if we have low interest rates keeping zombie firms alive, then the perennial gale of creative destruction is temporarily stopped from operating. Bad firms are not destroyed, and therefore poor firms do not enter. Accordingly, then, we have problems created for the long term in the economy, working first of all through the mechanism of the Financial Stability Committee, by broadening its mandate to doing things which it was never intended to do and is not qualified to do. Secondly, by deterring investment by the effect in the value of pension funds. And thirdly, by propping up zombies. Inflation has been stoked up, as Tim so admirably clearly displayed. One way out of the inflationary problem, and also a way of dealing, of course, with the very high amount of debt that has been built up, is to encourage economic growth. Government should be doing everything they can to encourage growth, or at least getting out of its way. What they are actually doing, with regard to their instructions to the Monetary Policy Committee, and to some extent the Monetary Policy Committee, is hampering growth. So they are working entirely counterproductively through one of the two core functions of the bank. It is seriously misguided policy in the US, in Britain, and in the EU, and in most countries of the world. It will, I think, as Tim is pessimistic, I too am pessimistic. Tim thinks these policies will raise inflation. I think these policies will also threaten the economic growth, and I can think of scarcely any more damaging combination for an economy. And on that cheerful note, Juan, I shall conclude and hand back to you.
Thank you, Geoffrey. Thank you very much. Brandon, the floor is yours, please.
Well, I came to this, as Juan, I think, has alluded to, basically by doing some research on how quantitative easing affected the commercial bank balance sheets. So what's going on in a commercial bank balance sheet? And I will come to that, but it caused me very recently to start asking a question that was more related to the subject of this discussion. And that was, are there circumstances where there is a realistic chance that the commercial banks, by expanding their balance sheets, would start to take over from QE as a source of very rapid increases in broad money? And if M3, basically, bank deposits, if that was to happen, or for that to happen, the banks would need to expand their lending significantly. And that made me think that there are basically three factors which will determine that. Three factors within a bank balance sheet will determine that. The first one is the sufficiency of capital. Do banks have the capital to lend? Well, the answer to that is unquestionably yes. Look at UK banks, and we see tier one ratios of 20% or more. And basically that looks to be 3-4% above where they're expected to be. Individual capital ratios are not disclosed, but that's substantially in excess of where they're expected to be, or where they're required to be. And if we look in the US, by the way, for those of you more interested in the US economy, if you look at the commercial banks in America and their CCAR, their stress testing, which has just been completed, the rumor is that they've sailed through them. So yes, banks are in a position to do that. And moreover, they're in a position where they will probably get a boost in their capital, a significant boost in their capital this year. Last year, many banks in the US and Europe were affected by changes in accounting practice. Something called IFRS 9 in Europe, International Financial Reporting Standard number 9. It has a different designation in the US, but basically, in both cases, it required banks to provision on expected loss, the things that they might lose, they expect to lose, rather than incurred loss, what they've actually lost. Now, that had a big effect in 2020 because, well, clearly, COVID, etc., the general forecasts were for a terrible slump, etc., etc. So banks provisioned very, very heavily. Right now, we're facing completely the opposite. The bounce back of the economies, both in Europe and the US, look to be far more rapid than anybody had expected. And these provisions, therefore, which are made out of equity, will come back as a write back of equity onto bank balance sheets. So the banks will certainly have the capital. Do they have the liquidity? Well, that's where my research into QE came in quite handy. US banks, UK banks, and same applies to US banks, but UK banks are incredibly liquid. right now they're holding about 700, well, in excess of 700 billion of reserves. That's about 30% of UK government debt, by give you some sort of dimension on it. It's an enormous number. And many times what they would require for any form of liquidity management. So basically, yes, there is a lot of liquidity there. And it's been caused actually by the way in which the Bank of England has performed quantitative easing. An unusual, well, I think a lot of people, in a sense, get it wrong. I've heard lots of people get it wrong. Basically, they think that the Bank of England buys the gilts from the Debt Management Office. That would indeed be, in inverted commas, printing money, but it would also be a very, very direct way of funding the government. But that's not what happens. What happens is the Debt Management Office, as usual, issues gilts to the large commercial banks who act as primary dealers for those gilts, i.e. they sell them into the market. And now whether they've been selling them to the market or not is actually a matter of some research at the moment, because I think they haven't, and some other people, somewhat more distinguished than me, think they do. But then they probably weren't running commercial bank balance sheet. So one of the more interesting things I think here is that because the central bank then, after about 1 month, buys those gilts back from the commercial banks in order to create the quantitative easing, it gives the banks reserves. Now, so therefore, what is happening is that the central bank, on behalf of the Treasury, is in a sense creating an interest rate swap. What it's doing is accumulating fixed rate, 15-year on average, government gilts, fixed rates, long-term rates, and is effectively swapping them for reserves on which it pays the commercial bank's base rate. Now, right, today's rates, that doesn't matter. But if any of you have ever, and this was a lot of my research, was looking at the effects of this interest rate swap on the likely cost of government debt in the circumstances where interest rates start to rise, because clearly base rate rises with interest rates straight away. And 15-year government bonds, well, they only rise basically over 15 years. So it has very little effect at first, if any, but it has. But the reserves have to be paid for straight away. So just an interesting point there. Do the banks have enough reserves? The answer is yes, they have more than sufficient reserves to expand their balance sheets to virtually any figure you can imagine. Do the banks have sufficient confidence? Because that seems to me to be the third question. And that's quite an interesting one to answer. I obviously go to quite a lot of bank conferences and talk to bankers. And one of the more interesting things is the number of presentations that have been given on the way in which basically credit models of one kind or another have been somewhat causing people to scratch their heads during COVID, partly because the data becomes very polluted by the COVID issues, and partly because the algorithms themselves become somewhat polluted by the effects of COVID. So basically, banks have been very nervous about their own credit models, but that's starting to change because the economy is coming out of this COVID period very rapidly. In fact, the economy seems to be coming out rather more rapidly than we are. So whilst bank deposits over the period of COVID have risen very rapidly, 20 to 30% a year, nonetheless, an SME lending has risen by 100% over that period. That was largely due to government programs backing them. But that stopped recently. But what has happened is SME lending in particular has risen very dramatically over just a few months. And it's gone from about 170 billion to about 216 billion. And most of that rise has had nothing to do with government backing. That's been commercial lending. It's also interesting that mortgages have been growing fairly rapidly, but mortgage rates are mortgage margins, margin the banks keep, not the rate, the whole rate, but the margin the bank keeps. It's actually quite wide by historic standards and is likely to fall, I think, in the future. So there is as competition returns. And all the treasurers I talk to seem to think competition is going to return. And interestingly, just last week, some 1.5 million small businesses in the UK made their first repayments of their bounce back loans. And again, the strong steer I'm getting is that much more money was repaid than expected, and more people repaid than expected. In other words, defaults were very small. So for these reasons, I think there is a possibility. The banks have the capital, they have the liquidity, and I think they're rapidly gaining the confidence to expand their balance sheets. And if it grows rapidly in 2021, and they do take over effectively from quantitative easing in growing broad money, then I can't see anything stopping a significant rise in broad money in the 2021, 2022, and possibly even onwards. So there is the possibility of rapid growth after QE in broad money, is my conclusion.
Thank you, Brandon. Very interesting indeed. Now we have approximately 20 minutes for discussion among ourselves, and then we will open up a Q&A time with the audience from home. So I have a few questions here for yourselves. If I can start with Tim. As you know, Tim, in the Federal Open Market Committee recent meeting in June 2021, it was very clear that what the Fed thinks is that the current rise in inflation is going to be very much a one-off. And by the end of the year, it's going to be in the 3 to 3.5% band or territory. So they're not very worried about inflation. So two questions about it. Do you think that this announcement by the Fed is credible, that inflation is going to return to something closer to 3% by the end of the year? And if it's not credible, how would you explain that markets' inflation expectations are still very much in line with the Fed's announcements? Thank you. Sorry, Tim, you have to unmute your mic.
Yes.
Thank you.
Okay. Well, just earlier today, Juan, in fact, I did a bit of work on all this, and it came as a real shock to me what I found. The Federal Open Market Committee is the key policy-making committee in the world's leading central bank. And you'd expect what they do to be absolutely top-notch. Okay, now they've got their view looking ahead. This is something published with their press conference, looking ahead 2 or 3 years with their inflation forecast. The inflation forecast for 22 and 23, end of 22 and 2023, are 2%. Now, I think it's going to be wrong, but at least, you know, that they're allowed that. The view they have for the end of this year is middle of the band of 3.3%. So the increase in the US Consumer Price Index from the fourth quarter 2020 to the fourth quarter 2021 is 3.3%. Look, I can check, not very difficult, the increase in the Consumer Price Index between December 2020 and May 2021 was 3.3%. What they are saying is that there'll be no increase in consumer prices in the next 7 months, even though in the first 5 months of the year, the average figure was 0.6% a month. This is incompetence on a staggering scale from people who are supposed to be, as I say, absolutely top notch. And one has to wonder what's going on here. Obviously, the wider question is, you know, the nature of macroeconomic analysis, and you know, this sort of second question you raise of, you know, what's going on here? It's not very surprising to say that inflation is caused by excessive growth of quantity of money. Last year, we had the fastest growth in the quantity of money in the USA since 1943. To forecast rising inflation because of this money explosion is not very surprising. So how is it that all these people in universities, central banks, and so on can, you know, the forecast I'm making is regarded as OTT, extraordinary and so on, but I'm just using a standard theory that's worked, by the way, many times in the past. I've successfully forecast other problems of this sort. And, you know, in a way, I want to scream. Anyway, I hope this sort of discussion gives the audience some idea of the sort of work we do at the Institute. And there's kind of questions we raise on the MSc course in the discussions and debates that we have.
Thank you, Tim. Well, as you know, in the mainstream models used by central banks nowadays, what are the determinants of inflation are two major variables. One is the level of the output gap, and the other one is inflation expectations. That's why I'm very puzzled, actually, that financial markets expectations of inflation are still very, very moderate. And how could it be? I mean, is it that they don't anticipate inflation? Is it that they think that the Fed is credible? They will change course in due time in order to take in inflation?
I'm sure Geoffrey and Brandon probably want to come in here, but can I just say, it really isn't true that financial markets are all wise. They aren't. And can I just say on this front that in the 30 years up to 1974, if you invested in British government bonds, say in 1945, the end of the Second World War, the yield was about 3%. That was ahead of the big inflation we had in the 30 years after the Second World War, which peaked in 1975 at an inflation rate of 27%. And in 1974, the yield on government bonds went up to 16, 17%. Didn't high as inflation, but it went up to that. So people had a huge capital loss in nominal terms on the government bonds, and the MSc course to explain the pricing of government bonds. And they also suffered from inflation. So if you bought the debt issued by the British government in 1945, Britain just having won the Second World War and having won all its wars and model of stability over centuries and so on, you lost between 1945 and 1974, you lost 97% of your investment in real terms. I'm sorry, there's no way financial markets and investors are all wise. And I'm very worried that many of the current investors in government bonds all around the world are going to be wiped out in similar fashion in the next 10, 20, 30 years.
Thank you, Tim. I know that it sounds obvious to you, but as you know, quite many people, actually the majority of market analysts, they think that even if money grows by 25% as it did at the peak last year, if inflation expectations are moderate, we shouldn't worry about it.
They're living in a fantasy world.
Can I add a few? I mean, Tim is, of course, correct in that very brief summary, but can I add a couple of things to that?
Please.
First of all, it is conventional to read inflation expectations from bond yields. That assumes, of course, everything is adjusted in the market, it's absorbing all the information. But just at the moment, we need to remember bond yields are being rigged. The market is being fixed by the central bank. So we cannot really infer market expectations from bond yields because the central bank is fixing the market. That, I think, is the most basic point. Secondly, when we say that markets are rational, well, people speak of rational expectations. I think that's actually a rather dangerous term. People understand rationality to mean people are being sensible. The late Alan Waters had a much better name for this form of expectations. He called it consistent expectations, consistent with the model of the world that people are using. If people are using it, are forming expectations in a way consistent with their own model, then they are behaving at least internally consistently. Now, what model do they have of inflation? If we listen to what they say, inflation is actually caused, strangely enough, by rising prices, because they always point to the price which has gone up most. They say that's what's causing inflation. Many distinguished people have held that. Arthur Burns, chairman of the Federal Reserve many years ago, stuck to that theory for many, many years. And if we look at what happened after him, inflation got completely out of hand until it was brought down by Paul Volcker, who had the good sense not to believe that inflation was caused by rising prices, but inflation was caused by, as Tim has pointed out, and now it's too, caused by excess money. So people who do make mistakes, people who do have wrong theories, and they are eventually, I'm afraid, brought into confrontation with reality and error is shown.
Thank you, Geoffrey. Before I ask Brandon to step in, as if you were, Geoffrey, would you mind clarifying what you meant by the bond market being fixed by the central bank?
The price you see in a bond market is, in theory, the long-term real rate of interest, which equals the growth rate of the real growth rate of the economy, plus expected inflation. Because under those circumstances, borrowers and lenders should be happy that they're getting what they expect in real terms after the inflation. Now, just at the moment, there are two major buyers of government bonds. One is the central bank, and the central bank, of course, is buying them to finance the government indirectly, as Brandon has pointed out, regardless of what they expect to happen to inflation. So there's a major buyer who has no concern at all about inflation. And a second and very important point is there are some buyers who are forced to buy bonds, regardless of how they expect them to behave. These buyers are pension funds. Most private sector pension funds in Britain have to have large government bond holdings in the mistaken belief, mistaken assertion imposed on them by regulation, and government bonds are safe. That is just not so. That regulation was brought in response to a fraudulent attack on a pension fund, nothing whatsoever to do with investing in dangerous assets. And because they are forced to buy these bonds, and they are major buyers, again, the bond market is distorted by people whose views of the outlook for inflation are in fact irrelevant to their behavior.
Thank you, Geoffrey. That's very clear. Brandon, do you want to add something? Yeah.
Certainly. I mean, I think if you, I'll go in a little bit to some of the research, because the interesting point, well, for me, one of the interesting points here is that before QE, about 2/3 of UK government debt was fixed rate over an average life of about 15 years. If you look at it today, that's a 1/3. Why? Because the banks, which hold actually the largest amount, about 700 billion, or held about 700 billion, sorry, now hold that as reserves. So that's on a short rate, very short rate, base rate. 100 billion, sorry, roughly is in index linked. And that leaves about 500 billion right at the moment, which is still on fixed rate 15-year. So long-term rates have been declining as a function of how much of the UK debt is actually funded. And that decline has been both in relative terms, but also in absolute terms. So it is really only the forced holders who are actually holding these anymore. And that, I think, is a fascinating issue. I think the other one was, if you go in, and this is where we start getting quite detailed, I'm afraid, but if you go into the way in which QE may be being executed by the commercial banks, it may well be, and certainly this is where research is going now, it may well be that it actually isn't having any effect at all on long-term rates, because what happens, I suspect, and this is the proposition I put forward and that's being researched, is that actually the purchases by the big banks from the DMO are actually not being sold into the market at all at any point. They're actually being repoed on overnight. And if that's happening, there is no effect on long-term rates at all. There's no signal from the long-term market, because there isn't one. They're just going to cash, and the cash market is funding this, and then the banks are selling them to the Bank of England. So you have a sort of loop which completely ignores long-term rates. They could fit it at any number you wanted, because it doesn't matter, because it never gets into play in terms of value of the bond. The bond is simply being repoed. So if that's correct, then it gives a very good explanation of why we're not seeing any real effect on long-term rates at all from QE, because it doesn't really have any effect on that market. The forced holders are holding them. The banks are, I would suggest, repoing them overnight and giving them back to selling them back to the Bank of England for a fee. So basically making a turn on their role as primary dealers. So that, I think, is probably what's going on, and that would account for why there is really no reverberation on the longer term market. And I think there are other reasons that again, they haven't, in a sense, nothing to do with just the monetary debate. But if you look at other debates which are being brought into scope, I think there are two big factors which we need to do more work on. The first one of these is that all the people are on furlough. Interestingly, how many people are on furlough and how many people on furlough have not got a job, i.e. not actually going out to work each day? That's an interesting one, because if you look at the ONS statistics for how many people are not in work, i.e. didn't turn up for work today, now those are usually, that number's usually determined by things like holidays, sickness, etc., and people looking for jobs, claiming benefit and looking for jobs. That number normally is around 2.5 million. If you look at it today, it's about 3.7 million. That's an incredibly low number. Why? Because it implies that only 1.2 million additional people are actually, it implies that 1.2 million people are actually not employed. But if you look at how many people are on furlough, it's about 2.4 million. So basically, it looks like half the people who are on furlough have actually found another job. You're perfectly allowed to do that, by the way. I wonder how many people who were flipping burgers are now driving vans. And that seems to me to be one of the reasons why we might be seeing a much tighter labour market than we're actually expecting, because we're focusing on the wrong number. We're focusing on furloughs. We're not focusing on people not actually in employment. And the other one, I think that you know, that needs some more thought given to it, is that there's a lot of international issues come into this. We've been told all along that, and certainly something I actually think has had a big effect on inflation, there's been the emergence of China into the international market. Globalization, but basically in a sense Chinaization, because look how much stuff is made in China. And Chinese growth has always been basically international looking. It's looking to sell goods. It has very deficient demand in the domestic economy, and it needed to sell goods overseas in order to boost its economy. It's gone for that sort of economic development model. But that model probably doesn't suit it anymore. And one of the things I've noticed recently is that the weakening of the renminbi has not happened. They're not weakening the renminbi as they used to when they needed to pick up the Chinese economy. Now, that would make sense from several angles. One angle would be they have a declining population. Why wouldn't you make that population more wealthy? Two, they are grossly over-reliant on US demand. And with political issues the way they are, why would you not want to boost domestic demand, which you would do better by increasing the value of the renminbi, not depreciating it? So rather than exporting deflation, my view is that China will now start to export inflation. And so I think you have two other factors here. I think labour markets are much tighter than they look. And I think China is not going to, that's not going to be where the cavalry is coming from to save us from higher prices for goods and services, quite the reverse. So I think even if you take away the monetary arguments and look at some of the facts around some of the other arguments that are made about excess labour supply, etc., then I think you can just you should be wary of those. I think that they both also are starting to point in different directions.
Thank you. Thank you very much, Brandon. So far, we have focused on the effects of the policies implemented by major central banks, the Federal Reserve in particular, on monetary aggregates, on inflation indeed. But Geoffrey, perhaps you could tell us a bit on the effects of these policies on financial stability in the medium and the long term.
Well, the effects on financial stability, I think, would come, would they not, from two channels. First is quite simply that slowing growth would harm the profitability of the banking sector, and unprofitable banks are very dangerous to an economy because it makes it easier for them to fail. Secondly, the slower is growth, the greater will be the struggle for what there is of the fruits of that growth. And this in turn will cause instability in the economy in terms of strikes and so forth. And then we would add to this the fact that the government is demanding an extraordinarily large share of the economy. Now, I don't want to be unkind to our Prime Minister, but it does seem that at the moment, every time he speaks, he spends a large amount of money.
I'd like to.
That is not really a way to promote financial stability, because the money has to come from somewhere. Is he going to borrow it, or is he going to tax it? Either of these things has implications for the economy. So in the longer term, financial stability is being diminished indirectly by these growth and profitability harming actions. And that is, as I emphasized in the past, not good news. If we look at what happens when an economy is grotesquely financially unstable, we have the US in the 1930s, the greatest depression in recorded history, a spectacular number. Contrast that with Canada, always an exciting country, or with Britain. In both countries were models of financial stability, and in consequence, they did not have great recessions. So instability can be very, very dangerous indeed, and that's being increasingly threatened by the government's actions.
Thank you, Geoffrey. So Tim, if I remember well, last year you wrote a paper on the money equity channel in the transmission of the policy decisions by central banks, first through asset prices, and then eventually through demand and CPI prices. So can you comment on it? Would you anticipate that the recent increase in the amount of money, the surge in the amount of money in America, is going to end up in a sort of a boom and bust cycle in the next few years?
Okay, Juan, can I just ask, was that a question from the Q&A session, or is that your I mean,
that's my question.
Okay, well, just put this in context. It's a standard university macroeconomics course. What you're taught is that an increase in the quantity of money reduces the rate of interest, which really means the bond yield, through what Keynes's liquidity preference theory of the rate of interest. And then the drop in the rate of interest increases investment in the national income sense, and national income rises by a multiple of investment. I have to confess, I wrote a couple of essay questions in my A-levels with exactly that answer, and I got very high marks for them. It's rubbish. And when the quantity of money increases, all asset prices are increased. And the effect of increase in money on bond yields, which is what Keynes meant by the rate of interest, is a relatively minor aspect of the whole story. The effect of the increase in the quantity of money on equity prices and the prices of real estate, property, as we say in Britain, real estate in America, on real estate, houses, commercial property, is far, far more important. And all I did in this paper that I wrote last year for the Journal of Economic Affairs was to spell this out in a bit more detail. And the importance of it is that you get people like Paul Krugman and Larry Summers. They're all they simply repeat the message of Keynes in this book written 80 years or so ago now. That a monetary policy can be ineffective because interest rates can't fall beyond a certain point. No, monetary policy will always work, always work, because an increase in the quantity of money can always be put into effect by the central bank, and that will always affect, crucially, equity markets and real estate markets. And my word, are we seeing that at the moment?
Oh, thank you, Tim. So, Brandon, we have only 2 or 3 minutes for another question, and I was very much interested in your presentation and the potential consequences in the way in which QE has been implemented in the UK. One of them is that if interest rates increase, even if just modestly, it would be well, it would be politically difficult to justify those payments by the Bank of England to the banking sector for those accumulated reserves in the last few months. So that's potentially a difficult PR position for the Bank of England to maintain. The other question that I want to put to you, and obviously, well, to the rest of the panel, is under which circumstances you think that the banking sector will be able to take over QE and to start lending at a much faster pace?
I think if I go on the first of those, perhaps everybody else can come in on the other one. But on the first of those questions, I think it is that, of course, it's going to be politically impossible. It's there is such a thing as political economy, and this is just this is way in the politics bit of it. How on earth at 700 billion, I mean, by the end of this year, that number will be probably near 900 billion, given the amount of QE going on, and certainly in the 800s, and that will make it the highest single cost of any rise in interest rates. So for every 1% rise in interest rates, the central bank would need to pay the commercial banks about £8 billion, and that would go pretty much straight to the bottom line. And that's I think impossible to justify, and I think it will be the end of the current policy of remunerating reserves. Now, I think you can do two things there. You can go back to the policy that was implemented during the time of Lord King and Mervyn King as was, who still is, I guess, but he implemented splitting the reserve balance into two. One was a target reserve number, which we were paid base rate on, and the other was not remunerated. That was the excess reserves. Subsequently, that was brought in, by the way, because overnight rates were extremely volatile, and because the banks tried to hit as low a number as possible every night. And I remember doing that, and that was a bit of a nightmare, but it also led to very volatile rates. So the target over a month was brought in, and on that target you were remunerated, on the rest you weren't. I think that may well come back. That will be my probably start of a 10 as the best solution to that. But you could go down the US route, which is to split reserves into reserves and excess reserves, and then pay different interest rates on the two balances. I think that's inevitably going. Something like that is I think inevitable. You could take. I think it will be right to say that. Well, I won't mention him, but a very famous UK economist's view is that you should never pay anything on any reserves. But I think that does lead back to the instability issue about banks trying to manage to a virtual zero number at the end of each day. So I think, I think that what we're going to see is the policy would have to end. Now, one of the interesting things about that, of course, is that that policy is going to hugely affect the cost of government debt. But one of the more interesting things that I have to say is that the number that's endlessly bandied around is 25 billion as the cost of a 1% rise in interest rates. And it doesn't matter how you take those numbers apart, you don't come to a number anything like that. 15-year debt does not reprice for 15 years. So basically 1/15 of it rolls over every year. That's all. So the fixed rate debt is, and arguably, even if you raised interest rates by 1%, rates will still be below where they were 15 years ago. In fact, they would be. So that's going to save you some money. Index-linked gilts are going to go up by about 600 billion. They're going to go up by the 6 billion. And as I say, the reserves, well, it depends on how big a reserve you want, in a sense, you want to pay on, and what you're willing to put up with for, in a sense, not paying on. But I think at the very least, we're going to see a split in the balance on the US lines. I suspect it might more likely be back to the Mervyn King process of having two targets. Well, a target and then an excess. So I think that's what's going to happen. In either case, you are likely to end up with a cost of UK government debt for every 1% rise in interest rates, and something around 8 or 10 billion, I think.
Thank you, Brandon.
I mean, it will increase over the years, obviously, but yeah.
Sorry
right.
for interrupting. It's just because we need to open up the Q&A time with the audience. But before doing that, I hope you don't mind if I just share some information with the audience about the master's, the postgraduate programs that you have been mentioning in your presentations. These programs are taught at the University of Buckingham. We offer two different programs. One is the Master's in Money Banking and Central Banking, which is in normal times taught in campus. And the other one is a postgraduate certificate in Money Banking and Central Banking that is indeed entirely offered and taught online. So if you were interested in how money is created, how money is destroyed as well, and the effects of changes in the amount of money in prices, asset prices, consumer prices, and the evolution of the economy along the business cycle, this is a very unique program. Unique in the sense that we do focus on a very important actor, the actions of a very important actor in affecting macroeconomic outputs in the economy, which is the central bank. We have two modules entirely focused on central banks, Central Banking 1 and 2. The first one is on the history, strategies, and operations of central banks. The second one is very much focused on monetary policies, how they make policies, and also those policies that central banks should implement in times of a great crisis. Those two modules are taught by Geoffrey Wood, one of our panelists today, and I'm afraid also by myself. And then we have another module taught by Brandon Davies, Banking Risk Management, on bank regulation and different techniques to assess banking risk. And associated with that one, we offer the possibility to our students to gain a professional accreditation in risk management by Premier. And Tim teaches a very important subject in our master's, is the central bank, the banking system, and the macroeconomy, which is effectively monetary macroeconomics, from a very different perspective from mainstream, a perspective that will allow you to, for example, if you had studied this master's last year, to anticipate changes in inflation later in 2021 and 2022. You wouldn't be shocked by that result if you had taken this module. And then we have two other modules on research methods in macroeconomics, which is econometrics applied to macroeconomics, and financial analysis. The master's finishes with a dissertation term. You will need to submit a master's dissertation either in the summer or in the autumn. And we offer two entry points, one in September, another one in January. But again, if you cannot make it, you cannot commit to a full-time master's taught in campus, we offer the possibility to gain this expertise by taking only 4 modules, those that I highlighted there: Central Banking 1, Banking Risk Management, the Central Bank, the Banking System, and the Macroeconomy, and Central Banking 2, fully taught online. And as ever in Buckingham, we teach our students in very small size lecture and tutorial groups that will actually makes it very easy for us to engage in discussion with our students. And in normal times, again, we have an annual visit schedule to the Bank of England. We visit the archive of the bank, and we're giving a seminar by senior economists of the bank. And indeed, we involve our students in the Institute of International Monetary Research events and research agenda, and even we offer internship opportunities to our students. And for next year, we have scholarships available for the September 2021 entry and January 2022. If you want to learn more about this program, well, feel free to contact the University of Buckingham, myself. Here you have my contact details, or just go online and search for the websites of these programs. And without any other interruption, I'm going to now address the panelists with the questions put by the audience. So one of our viewers from home is asking with US inflation expected to run at 5–10% for the next year or two, how can one best preserve the real value of the financial assets that one must rely on in old age? So basically, how can we protect from inflation? How can we protect our income, our wealth from inflation? Anyone?
Well, I have actually made that forecast that we'll be doing so, that inflation in the next couple of years is going to be in the 5–10% band in the United States. I'm not sure it'll be quite so bad here and in Europe, but anyway, certainly I think there's an inflation problem coming up, much more serious than what we've had so far. Let me just say, get this clear, that we have had huge asset price inflation in the last year. And so, you know, if your pensioner at the moment with a pension pot based on equities, you're laughing. Now, obviously, this may be a false impression, and maybe that fool's gold and so on. In the long run, all being well, equity prices will go up with national output. And so my advice to anyone really is insofar as you can control the assets in your pension fund, have it in the equity market, don't have it in gilts and bonds. And in the end, that should protect you. By the way, that was the pension philosophy that prevailed before the regulators got into this in the 1990s. And the British pension industry did its beneficiaries very well for a long time. I am terrified about what's going to happen in the next 10–20 years, I have to say, because the bond proportions are all wrong. And a lot of people are going to be badly hit by the fact that bond proportions are far too high because of regulation, basically.
Thank you, Tim.
Yeah, I mean, I would simply add, within equities, look for companies that have pricing power. You don't want to be a price taker, you want to be a price maker. And there's some very obvious ones these days, because there's quite a lot of, shall we say, highly concentrated industries around. And also look for those that will be positively affected by inflation. So certainly some raw material markets will fall into that category.
Thank you. Actually, there is another question by the same viewer from home. If US inflation persists above 5% and heads towards 10%, do you expect the Federal Reserve to choke off rising inflation a la Volcker, or to indulge it like Arthur Burns did? So what's the reaction? What's your expectation about the Fed's reaction to rising inflation later in the year, perhaps?
Can I perhaps say a word on this one? It's based on actually looking at the career of the chair of the Federal Reserve. She's actually a very distinguished economist indeed, if you look at her research publications. But they are all research publications in the field of microeconomics, economics of education, returns to the individual from investing in education. In other words, they're all in the area which leads an economist very naturally look at the prices of individual markets. She will, I fear, because of her experience, her very considerable and valuable experience, be a very firm adherent to the theory that inflation is caused by rising prices. So she, I think, will be reluctant to abandon that theory. Now, what effect this will have on the FOMC, we of course don't know, because we have no experience of how the FOMC behaves under her, how they behave, if they are willing to dissent and argue. They are under some chairman, under the chairman they're not. And we have absolutely no experience of that. The wise thing would be, I think, to be pessimistic and assume that they would go along with what the chairman wants, at least for a year or two. And that would indeed not be at all optimistic for inflation in the US for the next 2 or 3 years, at least.
Well, can I just say that I don't disagree with that at all, but it brings back to a theory. And what I would say is that the rate of inflation will be equal to the rate of money growth, broadly defined money, please, minus the rate of increase of national output, with an adjustment for the change in the desired ratio of money to income velocity, which in the medium term doesn't change very much. So if we take it that velocity won't change very much and that the rate of growth of output is pretty much given, getting inflation back down towards 2% depends on reducing the rate of growth of money back to less than 5%. And then this depends basically on two things. One is, how much will the banks have to finance the American government? And then the second thing is, how much lending will they do to the American private sector? Those are really the two key questions. We talk about those things in our research and the monthly publications and videos that we send out from the Institute. Given that America has a large budget deficit, and given, as Brandon has explained, that banks have got plenty of capital and liquidity, I think controlling getting money growth back down to less than 5% is going to be hard. And one of the worst things about the present situation is that none of the policymakers are thinking in these terms.
Thank you, Tim.
And banks are likely to be very profitable in these circumstances, remember. So banks will have little reason to curb their money growth, because it'll be very profitable for them. Their defaults will likely to be low because people pay back in nominal money. So I suspect that the only way I can see curbing is to substantially increase capital ratios, but they're already extremely high and the banks are well in excess of them.
I mean, can I just say, Brandon, it's fine, but you know, there's going to be a bust out there too.
Oh yeah.
Yeah, you know, I mean, it's so sad. I mean, this is so unnecessary, and you know, I'm sure Geoffrey, we know we're going through another period of kind of a great destabilization. There's going to be financial instability and so on. And it really is, I'm afraid, that in my view, it's a terrible shame, but it's a fault basically of economists.
Another question very much related to this one. How long will it take for velocity to revert to normal? And could it not be possible for people to hold more money relative to income for a few years relative to trend?
I see that addressed to me. This is an interesting question. Obviously, just we look at the evidence really, and it's clear that last year was, you know, an extraordinary outlier. People couldn't spend, and the central banks and governments were creating money on a massive scale. I would say usually, in my experience, excess money, and some, you know, the economy can have, there's the right amount of money, or it can have too much money or too little. There's too much, there'll be a boom and rising asset prices. Too little, there'll be a recession and weak asset prices. Normally, these processes work their way through in 3 to 4 years. And when you get a situation of really extreme excess money, as we have at the moment, it will actually be a combination of rising prices, and then there will also be a policy reaction. And I just take us back to, say, 1943 to 47. In 1943, they had 30% growth of broad money. It was the Second World War. They didn't have much inflation actually in 44 and 45. 46, there was massive decontrol. Obviously then a boom. Early 47, inflation exceeded 20%. Inflation then came down in the medium term after 2 years, 48 and 49, in which there was no money growth at all. That's what's required, something like that, in the next few years to sort out the mess that the Federal Reserve has created. And I would just say here that the ECB and the Bank of England on this side of the Atlantic haven't quite gone to the extremes of the Fed, but they've also, I'm afraid, done rather silly things.
Well, thank you all. We have reached the end of the webinar, well, of the discussion, the roundtable, as if it were online, and with very gloomy perspectives on the economy. So I'm afraid we are heading towards higher inflation, the return of boom and bust cycles, and yeah, possibly even more financial instability in the next few years. So a very cheerful conclusion to end up the meeting. This is, as I said before, these topics are very much addressed in our postgraduate programs by the 3 panelists that we have had today. And may I just finish by thanking the IA for hosting the event, and also yourselves, Tim, Geoffrey, and Brandon, for your contribution to today's discussion. It's been very interesting. And also to all our viewers from home, thank you very much for joining us. There will be more webinars coming forward in the summer. Thank you all very much.
Thank you.
Thank you.